In March of 2026, the Middle East was really in the grips of this escalating crisis. And if you picked up, any traditional financial textbook, it would tell you that this is the absolute textbook scenario for buying gold.
Right. It's supposed to be the ultimate safe haven.
Exactly. The world gets scary, investors panic, and they pour their money into that shiny yellow metal. So naturally, retail traders all across the globe saw the headlines and they hit the buy button.
And we all know how that turned out.
Yeah. Gold immediately crashed. It plummeted like 13 to 15%. It just smashed right through key support levels and wiped out accounts in a matter of days.
It was a total bloodbath for anyone who just, trading purely off the news. And I think it perfectly illustrates this central illusion of trading XAUUSD gold against the US dollar.
Yeah, people treat gold like it's just the simple panic button.
Exactly. They don't realize they're actually stepping into a highly complex algorithmic battlefield.
Which is exactly why we're doing this deep dive today. You are here with us to figure out how to navigate this incredibly volatile asset without, becoming collateral damage yourself.
Because it is definitely not for the faint of heart.
No, it is not. So today, our mission is to decode this ultimate balancing act required to trade gold successfully. We are going to synthesize the macroeconomic drivers, the specialized technical indicators you need to actually survive the volatility, the institutional smart money tactics that are just hunting retail traders, and finally, that psychological warfare happening in your own head.
Because gold really does require a completely different mindset than standard Forex pairs or equities.
Okay, let's unpack this, starting with that massive drop in 2026. If the world was in crisis, why on earth did gold fall through the floor?
Well, it all comes down to the US dollar and interest rates. You have to really understand the fundamental mechanism of gold as an asset. Gold, unlike a lot of things, does not pay a yield. If you buy a stock, you might get a dividend. If you buy a U.S. Treasury bond, the government pays you a guaranteed interest rate.
But gold just sits there.
Exactly. It just sits in a vault. And it actually costs you money to store and insure it.
So when U.S. interest rates are sitting at historic highs, like they were in early 2026, institutional investors, the guys moving billions of dollars, they have a choice.
Right. They can hold a non-yielding rock, or they can hold U.S. dollars and bonds that guarantee them a massive risk-free return.
And in March 2026, the U.S. dollar was just an absolute juggernaut. It was crushing everything in its path.
Precisely. The strength of the dollar and those high interest rates, they acted like this massive gravitational pull. It completely overrode any geopolitical fear.
Wow.
That is the macro weather you have to check before you even look at a gold chart. If you are blindly buying a dip just because the news is scary while the Federal Reserve is, keeping rates high, you are essentially standing in front of a freight train.
Wait, so if a war breaks out, I shouldn't just blindly buy gold? It sounds like gold isn't just a panic button. It's more like a seesaw. And the U.S. dollar is just sitting right there on the other side.
That's a really accurate way to visualize it. What's fascinating here is how this plays into the U.S. dollar index, or the DXY.
Right, the DXY.
Traders are constantly taught that the DXY and gold have this perfect inverse correlation. Dollar goes up, gold goes down.
But our sources make it very clear that relying on that as a hard and fast rule will absolutely get you into trouble. I actually always tell my students to be careful with the DXY anyway, because it's so heavily weighted against the euro.
Yeah, it's not a pure reflection of global dollar strength.
But even putting that aside, the correlation just isn't always tradable, is it?
No, it's really not. In statistics, correlation is measured on a scale from -1 to +1, right?
Right.
What's fascinating here is how often the gold-dollar correlation just sits in this messy middle. It's only truly tradable when the correlation coefficient is at absolute extremes.
Like above positive 0.80 or below negative 0.80.
Exactly. If the correlation is sitting at, say, negative 0.65, they might generally move in opposite directions, but you're going to see massive intraday divergence.
So the dollar might spike, but gold might just, stall out instead of actually dropping.
Right. And if you based your whole trade on that dollar spike, you'd just be trapped in a completely stagnant gold position.
Ouch. So if the DXY is sitting in that messy middle, what is a better proxy? Because the sources mention some alternative currency pairs that actually give a much cleaner signal for gold's underlying momentum.
Yeah, so if the DXY isn't giving you a clear extreme, you should look at USDCHF, which is the US dollar against the Swiss franc.
Oh, because the Swiss franc is another classic safe haven asset.
Exactly. So comparing the dollar directly to it strips out a lot of that euro-heavy bias you get with the DXY. In the data we reviewed, USD-CHF was showing a highly tradable negative 0.81 correlation with gold.
That is super useful. And the other proxy that jumped out from the research was USD-ZR, the US dollar against the South African rand, which honestly makes total sense from a structural standpoint.
It really does. South Africa is a massive global exporter of gold.
So when gold prices move, it fundamentally impacts their national revenue and, by extension, their entire currency.
Right. The rand is just deeply intrinsically tethered to the metal's performance. When we looked at the sources, that USD-ZR correlation was sitting at a very tight negative 0.83.
So monitoring these pairs basically acts as your macro weather report. It tells you the true strength of the dollar against assets that actually matter to gold's ecosystem.
Exactly. It's about trading the reality of the market, not just the headline on the news.
But, knowing the weather doesn't mean you won't hit turbulence. Because gold is so hypersensitive to these macro shifts, like, a sudden inflation report or an unexpected word from a central bank, its price action is notoriously violent and erratic.
Oh, absolutely. We are talking $10, $20, even $30 spikes in a matter of minutes.
Right. So if you try to track that with a standard moving average, it's completely useless. The price will just slice right through your moving average, trigger a false signal, and snap back before your chart even has time to refresh.
Which is exactly why relying on basic retail indicators in the gold market is just a recipe for disaster.
Standard tools just break under this pressure.
They do. The volatility will literally chop standard indicators to pieces. You need tools that can mathematically adapt to the expansion and contraction of that price momentum.
So let's upgrade the toolkit here. The sources heavily emphasize Keltner channels over something standard, like a simple moving average. How do Keltner channels actually absorb all that volatility?
Well, Keltner channels are built around a central exponential moving average, usually a 20-period EMA. But the real magic is in the outer bands.
Because they aren't set at a fixed percentage, right?
Correct. They are calculated using the average true range, or the ATR.
And for the listener, the ATR is literally just a measurement of how violently the asset is moving. It looks at the true high and true low of recent candles, and it factors in any price gaps. It doesn't care about direction at all. It only cares about velocity.
Right. So when a big macro news event hits and gold goes absolutely wild, the ATR spikes.
Makes sense.
And this physically forces the upper and lower bands of the Keltner channel to widen out. They act almost like shock absorbers for the price action.
Here's where it gets really interesting, though. If the bands are widening to absorb the shock, how do I know when gold is actually breaking out into a real trend versus just, throwing a random volatility tantrum?
That is the million-dollar question.
Yeah.
You have to watch exactly how the price interacts with those outer bands.
Okay, what am I looking for?
Because the bands have widened to account for the current volatility. A random, noisy spike will usually just hit the upper band and immediately bounce right back inside the channel.
So it's just noise.
Exactly. But if the price hits the upper band and starts riding it, meaning you see successive candles closing outside or right on the edge of that expanded upper channel, that is a true bullish impulse.
Oh, wow. So the buying pressure is so intense that it's defying the expanded volatility range altogether?
You've got it. That's how you filter out the noise to find the actual signal.
Now, the sources also brought up the Ichimoku cloud. And I have to admit, the first time a student showed me an Ichimoku chart, I genuinely thought my monitor was broken.
It is a lot to look at.
Right. It looks like someone spilled paint all over the screen. There's just this massive shaded cloud hovering around the price.
It is visually overwhelming at first. I totally agree. But it is a brilliant way to visualize market structure and market balance.
How does it actually work?
Well, the cloud itself is formed by taking the averages of the highest highs and lowest lows over different periods, and then this is a key part, projecting them forward in time.
Wait, projecting them forward?
Yeah.
Like into the future?
Yes, the cloud is actually pushed ahead of the current price on the chart. It's essentially saying, based on the recent historical momentum, here is exactly where the battle lines are going to be drawn.
Okay, so how do we read it?
The primary rule is pretty straightforward. If the current price is above the cloud, you are in a bullish trend. If it's below the cloud, bearish.
And what if it's inside the cloud?
If it's inside the cloud, the market is flat. It's in equilibrium, and you should just sit on your hands and wait.
Okay, but why does the cloud change thickness? Like sometimes I see it as this thin little line, and other times it's a massive, thick blob.
That thickness is actually the most valuable part of the indicator. When the cloud is really thick, it means that the historical price averages over the short term and the long term are very far apart.
Okay.
It indicates that a tremendous amount of volume and price action occurred at those levels in the past. So it creates this dense wall of buyers or sellers.
So a thick cloud is an incredibly strong support or resistance zone.
Exactly. And conversely, a thin cloud means there's very little historical volume defending that price level, making it super easy for the price to just slice right through.
Wow, okay. So Keltner channels give us real-time volatility and momentum, and the Ichimoku cloud gives us the structural battle lines. But what about the actual entries and exits? The research suggested pairing Bollinger Bands with the Relative Strength Index, the RSI.
Yes, this is a very classic combination, especially for short-term scalping or spotting the exact moment a trend exhausts itself.
Because Bollinger Bands also expand and contract with volatility, right?
Right. When gold is just consolidating, the bands squeeze together tightly. When it breaks out, the bands explode outward.
But a breakout can easily be a fake out, which is exactly where the RSI comes in. If gold breaks out to a new high, pushing the Bollinger Bands wide open, you immediately look down at your RSI.
And you're looking for divergence.
Right. If the RSI is making a lower high while the price is making a higher high, that's divergence.
And if we connect this to the bigger picture, divergence is really the ultimate warning siren.
How so?
It tells you that the price is being pushed up purely by late-arriving retail traders who are just driven by FOMO. But the actual underlying momentum, the real institutional buying power, has completely dried up.
A reversal is imminent. It's like a car rolling up a hill. It might still be moving forward, but the engine is totally dead.
That's a great analogy.
But here is the terrifying reality of trading XAUUSD. You can have your Keltner channels perfectly dialed in. You can have a nice, thick Ichimoku cloud supporting your trade. You can spot the breakout, and you will still get completely destroyed.
Oh, it happens every single day.
Why?
It's not because the indicators are broken. It's because the indicators are exactly what the institutional algorithms are using to hunt you.
And this shifts us right from technical analysis into the world of smart money concepts, or SMC. This is where we really look behind the curtain of the market. We have to realize that the major players, the central banks, the massive hedge funds, they do not trade like we do.
They can't. They literally can't. If a retail trader wants to buy one lot of gold, they click a button and the order is filled instantly.
Right, no problem.
But if a major institution wants to buy $500 million worth of gold, they can't just click buy. There just aren't enough sellers sitting at the current price to fill an order of that size.
If they tried, their own order would cause the price of gold to skyrocket hundreds of dollars, and they'd basically ruin their own entry price.
Exactly. They have a massive liquidity problem. They need to find millions of dollars in sell orders just to get their buy order filled.
So where do they find them?
They manufacture them. And they do it through a very specific execution sequence that is entirely designed to trap retail traders.
Okay, let's break this sequence down. Step 1.
Step 1 is identifying untapped key levels. The algorithms look for obvious structural points on the chart that haven't been tested yet today.
Like what?
Like the previous day high, or maybe the lowest price reached during the Asian trading session.
Oh, because they know exactly where retail traders hide their stop losses. If I'm a retail trader and I'm shorting gold, my stop loss is sitting right above the previous day high.
Right.
And a stop loss on a short position is actually a buy order. Furthermore, there are thousands of retail breakout traders who have buy orders waiting just above that exact same line.
So right above that previous day high is just a massive pool of liquidity.
Which leads perfectly to step 2, the liquidity sweep.
Yes. During periods of really high volume, usually the crossover between the London and New York sessions, which we call kill zones, the smart money algorithms will intentionally push the price just past that key level.
So if the previous day high is $2,400, they push it to like $2,405.
Exactly.
So the liquidity sweep is basically a trapdoor. Retail traders see the price cross $2,400. Their indicators scream breakout. The shorts get stopped out. The breakout traders jump in, and this massive flood of retail buy orders hits the market. They just step right on the trapdoor.
And the very moment that artificial demand is created, the institutions drop their massive sell orders right on top of those retail buyers.
Wow.
They literally use the retail traders as the necessary liquidity to fill their own massive positions. The breakout immediately fails, and the price just collapses in the opposite direction,
Leaving all those retail traders holding the bag, wondering why their absolutely perfect technical setup just blew up their account.
Exactly.
So this sudden, violent snapback, That's step 3, right? Displacement.
Yes, displacement. Displacement is essentially the footprint of the institution. It's a heavy, high-volume candle moving very aggressively in the opposite direction of the sweep.
It proves the big money has entered the chat.
It absolutely proves it.
But the institutions move so much volume during that displacement that they actually leave money on the table, don't they? I mean, the price drops so fast that it just skips over certain price levels entirely.
Yes, it moves too fast for all the orders to pair up. And this creates what we call a fair value gap, or an FVG.
Okay, an FVG.
Because the price moves so aggressively, there is this pocket of unfilled orders just left behind on the chart. And the algorithms, they really don't like leaving unfilled orders.
So what's the final step of the smart money sequence?
The final step is just waiting for the price to pull back and fill that gap.
So if I'm trading this, I am not buying the initial sweep. I am sitting on my hands, watching the trapdoor open and swallow up all the retail traders. I watch that displacement candle crash downward. And then I just wait.
You have to wait.
I wait for the price to slowly pull back up into that fair value gap.
Yes. If we connect this to the bigger picture, the absolute highest probability entry is right at the 50% mark of that fair value gap.
So you enter there, right in the middle of the gap.
You enter there and you place a very tight stop loss just beyond the wick of the candle that made that initial liquidity sweep.
So you're risking a super tiny amount of capital because you are actually entering alongside the institutional algorithms. You're basically sneaking in through the secret backdoor they left open. But man, this requires an unbelievable amount of patience. You have to sit through the setup, the sweep, the displacement, and then just wait for the pullback.
It does, which is exactly why the majority of retail traders fail. Smart money engineers price, while retail traders just chase it.
And the reason retail traders constantly chase price, stepping onto that trapdoor time and time again, isn't because they're stupid. It's because of the incredible psychological grip that gold has on the human brain.
It's powerful.
Which brings us to the final piece of the puzzle today. The psychology of the safe haven bias and the emotional traps that are really specific to XAUUSD. I mean, I've coached hundreds of traders, and I can tell you people act completely unhinged when they trade gold.
I've seen.
If a tech stock drops a few points, they shrug. If gold drops $5, their heart rate spikes and they literally start sweating.
Because it triggers deep primal associations. For thousands of years, gold has represented wealth, survival, stability. So when you combine those deeply ingrained cultural associations with the sheer velocity of gold's price action, you get this toxic cocktail of cognitive biases that just completely short-circuit logical decision-making.
And the safe haven bias is definitely the deadliest one. We talked earlier about how the macro environment can completely crush gold, but on a micro level, intraday, traders simply refuse to believe it.
They really do.
Let's say a trader buys gold at $2,350. The macro weather is bad, the dollar is super strong, and gold drops to $2,325. Their technical stop loss tells them to exit. Their risk management plan tells them to exit.
But their brain says, hey, it's gold, it's a safe haven, it always bounces back.
Yes. So they move their stop loss, they widen it, giving the trade, more room to breathe.
Which is always a mistake.
They end up holding onto a losing position based entirely on hope. They abandon their entire strategy and rely on a generalized cultural myth.
And hope is just a terrible trading strategy. You'll just watch your account bleed out.
So what does this all mean for you, the listener? Are we basically fighting thousands of years of human biology when we trade gold? It feels like we are hardwired to act irrationally the second we see it drop.
We kind of are. And then there's the polar opposite reaction, which is FOMO and overtrading.
Oh, yeah.
The sources highlight how gold will frequently whip violently between ranges. Say it drops from 4,650 down to 4,610, and then instantly rockets back up.
That kind of whipsaw creates a huge adrenaline spike. The trader sees that massive green candle shooting up on the chart. They feel an intense biological urgency, like they feel like they are missing the greatest trade of the entire year.
Exactly. So they abandon their entry rules completely and just jump in right at the top of that spike.
Just in time for the institutional algorithms to execute their liquidity sweep and pull the price right back down.
Yep. The trader gets stopped out instantly.
Which inevitably triggers the final boss of trading psychology, revenge trading.
And this raises a really important question about emotional regulation, because when you get stopped out on a sudden volatility spike, maybe a news event like non-farm payrolls drops and gold jumps $20 in a single second, it feels deeply personal.
It feels like the market literally reached into your pocket and stole your money.
Right. Your prefrontal cortex, the logical part of your brain, completely shuts down. Your amygdala takes over.
You double your position size, you hit buy again, and you're just desperate to win that money back right now. All your analysis is gone. You are literally just gambling out of pure anger.
And that is exactly how accounts are blown in a single afternoon. But the sources do provide some incredibly pragmatic solutions to combat this physiological response.
Okay, what do we do?
First, you absolutely must separate analysis from execution. You do your chart work when the market is closed or when it's very quiet, and you set physical, written, pre-trade checklists.
I cannot stress the checklist enough. Having to literally look at a piece of paper and check off, is the DXY favorable? Is price at a fair value gap? Am I risking less than 1%? It physically forces your logical brain to re-engage before you click a button.
It's vital. Another crucial tactic is relying on price alerts rather than just staring at the chart all day.
Oh, chart fatigue is real.
Staring at a flickering gold chart for hours induces this hypnotic state of anxiety. You will start seeing patterns that simply aren't there just to justify taking a trade.
Right.
Set an alert for your key level, walk away, and just let the market come to you.
I love that. So taking all of this in, the true edge in trading gold isn't finding some secret magical indicator. It's really about mastering yourself.
Yeah.
You have to accept losses not as a reflection of your intelligence, but as mere data points.
If you size your positions correctly based on volatility, a loss is just a paper cut, not a fatal wound.
Exactly. If you're risking a tiny fraction of your account on a smart money entry, a loss is literally just a cost of doing business.
Because the market does not know you exist. It doesn't owe you a return. The moment you view trading as just a series of probabilities executed over time, the emotional weight lifts, and you can actually execute your edge.
Let's bring this deep dive to a close and sort of synthesize what it takes to actually survive the XAUUSD arena. We've really broken this down into 3 necessary pillars today. Pillar 1, macro awareness. You have to respect the US dollar, you have to respect interest rates, and the true macroeconomic drivers.
Remember the seesaw.
Yes, the seesaw. And don't trade the headline, trade the reality of the market.
Pillar 2 is technical precision. Standard retail tools will fail you in this kind of volatility. You need adaptive indicators like Keltner channels, and you absolutely must understand how institutional algorithms hunt liquidity.
Wait for that smart money sequence, watch the trapdoor open on a liquidity sweep, confirm the displacement, and enter calmly at the fair value gap.
And finally, Pillar 3, strict mental discipline. You have to fight your own biology, strip away that safe haven bias, use your checklists, and refuse to let a single loss trigger a revenge trading spiral.
Master these 3 pillars and you stop gambling. You actually start trading. Which leaves me with a final, slightly provocative thought for you to explore on your own. We've spent a lot of time today discussing how gold's legendary violent volatility is largely driven by human emotion, right?
Right. Retail traders panicking over geopolitics, acting out of FOMO, stepping onto institutional trapdoors.
Exactly. But we are rapidly entering an era where artificial intelligence is taking over both retail and institutional execution. If human hands are completely removed from the keyboard and AI agents are just trading against other AI agents based purely on math and probability, what happens to gold? Will the market suddenly become eerily calm because machines don't feel fear or revenge? Or, and this is the scary thought, will the algorithm simply evolve to weaponize sentiment data, scraping global panic in real time to trap human fear with a level of terrifying efficiency we haven't even conceived of yet? The game is changing.
It is a very sobering thought. The landscape is definitely shifting, but the underlying mechanics of liquidity and probability will always govern the markets.
Just remember, when you step into the gold market, you are navigating deep, treacherous waters. Keep your eyes on the macro weather, trust your specialized tools, and never, ever let your emotions take the wheel. Until next time, stay disciplined.